So what questions should we ask the dealer when we are negotiating our finance product and our other charges, if you like, or other products that they might try and tie in to our quotation? And that's what we're going to look at now. The first and the most important golden rule, I would say, is whenever they give you a quotation, always say or confirm with the dealer that the interest rate they are quoting you is APR, annual percentage rate, nothing else. We are not interested in annual equivalent rates, we're not interested in annual rates, we're certainly not interested in flat rate. We want APR. Okay, so when you are given a quote, and if the dealer says to you, yes, I can do you this special offer this week at 4%, make sure they're not saying 4% flat. The golden rule, and it's a very simple golden rule, very simple rule of thumb, is if they quote the flat rate, a good indication of the APR that you will see on that final agreement when you sign on the dotted line is roughly double the flat rate. So if you've got a 4% flat, you're probably looking, give or take a little bit, of about 7.9% APR. So the first thing to always confirm with the dealer is the interest that they are quoting APR? Okay. Number two, if it's a lease or if it's a PCP, there will always be an excess mileage charge. Now, what does excess mileage charge mean, and when does it come into play? Well, an excess mileage charge on a lease is probably more important than on a PCP. When you take out a lease on a car, you are agreeing an annual mileage, but you're actually agreeing, how many times can I say the word actually? You're actually confirming a contract mileage. And that's the same as on a PCP actually. So if I take out a 3-year lease and I say it's a 36,000 mile agreement, that means on average I can do 12,000 miles a year. But it doesn't matter if I do 8,000 miles in the first year and then I do 16,000 miles in the second year and then I do 12,000 miles in the final year. It doesn't matter. It's across the term. But with a lease, it's very important because when you come to hand the car back, because remember when we talked about a lease, there's often not an option to purchase the car. And it's often a lot more expensive to get out of a lease than it is on a PCP. So when you come to the end of the lease, they will say, okay, let's take our previous example. You've done 37,000 miles on this contract. You only paid to do 36,000 miles. So you owe us 1,000 times, because that's the excess mileage we've done, multiplied by whatever the excess mileage pence per mile charge is. So let's say it's 10 pence per mile. You've done 1,000 miles over. You would have to pay an additional £100 when you come to get out of the lease. It's that simple. Now with the PCP, it's not quite as important, I guess, because on a PCP the excess mileage charge only comes into play when you want to physically give the car back at the end. So at the end of a PCP you're free to trade in that car, which is what most people do, or you can sell the car to a car buying service, settle the outstanding finance and pocket any equity if there is any. If you actually go to the finance company and say, right, I want to hand this car back, I want to exercise my right to give the car back, and I've taken reasonable care of the vehicle, there's no excess charges to pay in terms of damage to the car, I want to give it back. The only time excess mileage will come into play is under that circumstance. So they will say, okay, you're giving it back. The guaranteed future value, let's say it's the same as our previous example. The guaranteed future value is £25,000. The car's only worth 20. So they will go, okay, yes, we'll honour the £25,000. We'll take the car back off you and you can get out of the agreement and walk away. However, assuming our previous example, you've done 1,000 miles over what the agreed contract mileage was on the PCP. You owe us 1,000 times 10 pence or 20 pence or whatever the excess mileage pence per mile is. So that's the only time it comes into play. So if you owe £25,000 on this previous example and the car's worth £26,000, it doesn't matter. You give it back and they'll honour it and they will pay off the agreement. You've got nothing more to pay. It only really comes into play when you want to physically give it back and the car's worth less. They will then start trying to claw some charges back. Okay, so always ask what the excess mileage charge is. Is the final value guaranteed? So that's another good question. So with a PCP, it should be. So again, let's just recap. What does that mean? We buy a car for 50 grand. 4 years later, we owe 25,000. That's the guaranteed future value, or that's the balloon payment on the agreement. The car's worth £10. As long as the end value is guaranteed, they will take that car back, minus any excess mileage, fair wear and tear charges, that kind of thing, and you can walk away. If it's a balloon HP, they are often not guaranteed. So basically, let's say with our previous example, it was a balloon HP. £50,000 purchase price, £25,000 balloon payment, so not guaranteed. You get to the end of the agreement, the car's worth £15,000. You've got to pay that agreement off. You owe £25,000, so you've got to find another £10,000 in addition to the £15,000 that the car's worth. Okay, so always double check, is that final value guaranteed? Tying into our previous example, again, very, very important. What is the equal amount of monthly payments on this agreement? I've asked for a 48-month agreement. Is it 48 or is it 48 plus 1 or is it 47 plus 1? I've asked for a 3-year agreement. Is it 36 equal payments and month 37 being where the balloon payment is or the final value is, or is it 35? And as we saw in the previous lesson, that can make a massive difference when you're trying to compare different dealers. Now, something else. Does the invoice price or does what you're paying for include any options? So they might have said, okay, the purchase price is £50,000. And they might say, well, you want paint protection. So that's, I'll tell you what, let's go back to the Excel example here. Let's say you've got a car £50,000, but you want gap cover, or they're selling you gap cover. That might be as much as £1,000. You can get it much cheaper elsewhere. And they've also talked you into paint protection, which is useless, and I would never recommend having it, even if it's free. You know, go to a detailer and pay them 500 quid to work their magic on the car. Don't get a main agent to do it. They don't have the time. But let's say you do. So let's say it's £51,500 now. £500 for paint protection, £1,000 for gap cover. That's now going to put our monthly payment up, look, to 772 from 737. So what's that? 47, 57, 67, about £35 a month. Now obviously we are paying interest on that as well. So I would recommend never tying in any other products unless they are genuinely free, certainly with gap cover. As I said, paint protection I wouldn't bother with. But if they are genuinely free, don't put them onto the agreement because you're paying interest on them as well. Pay cash for them. What I would do also, certainly with gap cover is a necessity, I would say. Always have it, but always shop around. You don't have to have it from the dealer. So go onto Google, direct Gap, click for Gap, gapinsurance.co.uk, ALA. There's loads of them out there. Just check the small print, make sure that the excesses are the same, make sure that the claim limits are the same, and then go to the dealer and see if they'll price match it. If they will price match it, fine, get it from the dealer, pay cash for it, or stick it on an interest-free credit card. Don't tie it in to the invoice of the car, okay? But if they won't match it, buy it elsewhere. There's plenty of places online. If they've managed to lower the monthly payment, so let's say you said, well, yeah, it's a bit expensive, and they come back and say, well, we can knock a tenner a month off. The only way for you to genuinely save money is like this. So let's say we've got our quote and it's $737 a month, and you say, well, I'd rather only pay $730. The only way to do that is to discount the purchase price. So let's say, I don't know, I'm guessing here, let's say they knock you 500 quid off. So the purchase price is now 49,500. Everything else remains the same, and we've got it down to 725. Perfect. Yeah, the charges are less, the monthly payment's less, the amount you're paying for the car is less. However, as we saw earlier, what they could do is they could say, okay, the purchase price is the same. What I'm going to do is inflate the final value slightly at the other end. So I'm going to make that 25,500. Well, look, we've got the monthly payment under 730, but our charges have gone up because we've paid more interest, because remember, you pay interest on this all the time. So we've increased the balloon payment, or the final value at the other end. And you can see how this affects early repayment as well. So if I go down to month 24, look now, you've paid less each month, but your balloon payment's gone higher. So to get out of that agreement would be £38,500 after 2 years. If I drop this to 25,000 and lower the purchase price to 49,500, our monthly payment has come down to 725, which is nice. But also, look, our payment to get out is now 38,000 and a penny. So it's a lot better to always keep the final value the same and get them to discount the purchase price rather than changing anything else. The only other way of doing it, if they won't budge on the purchase price, and this can happen with used cars, not so often with new cars because the APR is fixed, get them to see if they will lower the APR slightly. Let's try 6.7. Gets us to 731. Okay, our charges have come down, everything's come down, but the purchase price is the same and the guaranteed future value is the same. So the only way of saving money on a PCP especially, or an HP in a way, is to either discount the purchase price or lower the interest rate. Do not increase the final value at the other end. Yes, it will give you a lower monthly payment, but you'll be paying off less equity, you'll be building less equity in the agreement, and you will owe more throughout the term. Right, the final thing I want to talk about is